Oracle stock just reported earnings and the price boomed up 13.3%. And yes, so they did have all-time high in earnings per share, but that's not the reason the stock price is up so much. The reason is due to the high outlook for future revenue growth. And this is causing Wall Street analysts to completely rewrite their price targets for Oracle stock. And frankly, this is an interesting trend that could impact every big tech stock, especially related to AI. If you're invested in Microsoft, Amazon, Google, and any cloud provider, this is something you should know. If you don't know Oracle, this is Larry Ellison's company. He's one of the richest men in the world with a $240 billion net worth. And today's stock price gains increased his net worth by $23 billion, which according to Forbes is easily the largest daily bump of any billionaire ever. And I have a feeling things are going to get crazier and crazier. So today I'm going to do an update analysis on Oracle stock that will include a look at key financial metrics, the company's dividend payment as they are a sneaky dividend growth stock, the latest earnings results, and the outlook that sent the stock soaring. And if you stick around to the end of the video, we'll do our own DCF valuation for Oracle and take a look at some of the latest analyst price targets. With that said, let's roll the intro and get into this Oracle analysis. My name is Zach, this is Dividend Data, and you should leave a like and subscribe to the channel if you enjoy the video. Throughout, I will be using the stock research tools over at dividenddata.com, and right now we have our best deal we ever offer. You can get 50% off annual membership and lock in that discount for life. This summer sale will only be available for a limited time, so now is the best time to join. The link is in the description and pinned comment of the video, and you can try it out at no risk. There's a 30-day money-back guarantee. So let's dive into Oracle stock. So Oracle, ticker symbol ORCL. Current stock price is $199. And as I mentioned, it's up 13% today. And based on GAAP EPS, it is trading at a high PE ratio, but it's actually far less based on non-GAAP earnings per share. And it's important when you're analyzing stocks to not look at PE ratio in isolation because you have to take it in the full context of the growth of that business. As an example, if you're trading at 30 times earnings, but you have a 30% growth rate, that would actually be cheaper than a stock at 20 times earnings with 5% growth. But still, Oracle is definitely trading at a premium. They just hit their all-time high in stock price. And earnings per share growth over the past year really hasn't been that high. But over the long term, Oracle has been a great growth business in the market, and the stock price has followed that trend. But ultimately, the entire story when it comes to investing in Oracle will all be about those future growth rates, and I'll talk about that when I dive into the latest earnings report. But first, let's just take a big picture look at Oracle. Revenue per share has grown at a 10-year compound annual growth rate of 8.79% and a 3-year CAGR of 11.98%. This is a high-margin business. Gross margins are 71%, operating margins are 29%, and net margins are 19.79%. And despite the high growth, Oracle's free cash flow per share has actually not been growing that much. The 10-year CAGR is 3.28%. And we'll go take a look at their cash flow statement to explain why. As you can see when we open up the annual cash flow statement, the company has grown their cash from operations, but CapEx has soared in recent years. Since fiscal 2021, they've gone from $2 billion a year in CapEx up to 4.5 the year after, then $8.7 billion, and then 6.87. And this is going up even more. In Q3, they had $5.86 billion in CapEx. So that's why you see free cash flow not growing that much at Oracle. But you have to take this into context in that they are investing heavily in AI and data centers right now. They are building out infrastructure. And the reason is because they have some huge growth business with clear demand from customers, as you can see from their outlook that I will soon explain. Now, some of the negatives for Oracle is they do have a lot of debt. Their net debt is positive $78 billion. So the balance sheet is not as nice as some of the other big tech companies. But this company does generate a lot of free cash flow, and they are a dividend growth stock. The current forward-looking annual dividend is $2 per share, which gives it a 1% dividend yield. And what's a little different about Oracle is that they do not raise their payment every single year. Instead, they follow a pattern of raising the dividend every 2 years. But when they do it big. The 10-year compound annual growth rate is 12.79%, and the 3-year CAGR is 16.04%. The most recent dividend increase for Oracle was 25%, and the one prior was 25%. And this dividend is very sustainable with a 37% free cash flow payout ratio in 2024, despite the high CapEx. The EPS payout ratio is 41.9%. So let's dive into the earnings report, which really is the story that shot the stock up. To do so, I'm going to be using the AI analyst over on dividenddata.com. In my opinion, one of the best features of it is that you can ask it to summarize any quarter earnings call for any stock, and it sources from the real earnings transcripts and financial documents. And by the way, they just reported their Q4 2025, so this will end their fiscal 2025. So as an example, you can see with Oracle here, overall revenue for the quarter came in at $15.9 billion, which is up 11% year over year. Cloud revenue came in at $6.7 billion. That includes their infrastructure as a service and their software as a service. So that $6.7 billion was 27% growth year over year. So this is now about 42% of Oracle's overall revenue. Cloud infrastructure, which was $3 billion of that, grew 52% year over year. So this is a big growth business. But as I mentioned, that $1.70 earnings per share was their highest ever. But that's not the reason the stock went up. It really wasn't that big of a beat. Their revenue and non-GAAP EPS was up 9%. For the full year 2025, their revenue and non-GAAP EPS was up 9% year over year. The reason why the stock went up had everything to do with the outlook. And this is a very bullish thing for all of big tech, all of cloud infrastructure, and really the whole AI trend. For fiscal year 2026, they gave guidance of total revenue growth of over 16%, total cloud revenue growth of over 40%, infrastructure as a service revenue growth of over 70%. The Oracle CEO highlighted that growth rates for fiscal year 2026 are expected to be, quote, dramatically higher compared to fiscal year 2025. They also added that their multi-cloud database revenue and Oracle Cloud customer revenue are showing triple-digit growth potential, meaning over 100%. That's why Oracle stock went up. That means just under half of Oracle's revenue is going to be growing 40% in a year. And this is a big increase, 27% to 40%. That's a big jump. So when you see that, it starts to make sense why Oracle's CapEx is growing so much. The company is seeing clear demand, so they're investing to meet that demand. Over the trailing 12 months, their CapEx is $14.9 billion. And that's why you see their free cash flow actually going down. That is not looking good over their trailing 12 months. But that is no doubt a smart move as long as they have high earnings growth. As you can see, analysts have already been revising their growth targets. 12% EPS growth in 2026, 20.9% in 2027, 26% in 2028, and 30% in 2029. And the reason is that cloud portion of their business will become a larger and larger chunk of the overall pie. So based on this, Oracle is trading at 30 times next year earnings and 14 times 2029 earnings. So the whole story with Oracle stock comes down to those future growth projections and whether or not they hit or exceed them. So what is a fair value for Oracle stock to be trading at? Let's mess around with the discounted cash flow calculator over on dividenddata.com. This is within the AI analyst. You can type in any stock, their ticker symbol, and DCF valuation, and it will load up this estimate for you. And you can scroll down and open up this calculator so that you can change the variables yourself. And as I will soon explain, this is a difficult one to value because of the wide range of potential outcomes and the high growth rates we're talking about. So by default, it has 0% growth in 2029 and 2030. So let's up that to at least 17% so it stays in line with 2028. This is revenue growth, by the way. And we're doing this valuation based on exit multiple of free cash flow. And it has that defaulted to 50 because that's probably what it's trading at right now. So just by raising those future growth rates to 17%, that brings the implied share price to $146, which is overvalued before going up 13% today. But there's probably a lot more stuff we want to mess around with. As an example, another key factor here is CapEx, because DCF valuations are based on free cash flow. And as I mentioned earlier, the high CapEx is impacting the company's free cash flow, but they have very high operating cash flow, which is growing. So just as some context here, they're talking about $25 billion in 2026 CapEx, growing up to $35 billion a year in 2030. And again, we're at $14.9 billion over the trailing 12 months. So I definitely think it's possible to get up to this $25 billion number, but 35 to me seems like a pretty aggressive estimate. So as you can see, I'm gonna lower that so it's around $25 billion through 2029, and then we'll say just under 30 by 2030. And here you can see how that changes their free cash flow. It goes from 6.2 to 11.7 to 18.7 to $21.9 billion by 2030. So that could be a little aggressive on the free cash flow estimates, but when we up these numbers, you can see the implied share price is now at $210 a share. Again, this is assuming an exit multiple of 50, which is on the high side. So let's lower that down to something like 35. And that puts the implied share price at $141. So we're back to where the stock is very overvalued. But hey, let's say we're an Oracle bull. Let's up these revenue growth estimates. Do 20% in 2027, 20 in 2028, and then let's say 25 in 2029 and 25 in 2030, because those higher growth businesses would become a larger part of the pie at Oracle. So if they keep growing at, let's say, 40%, then overall revenue growth at Oracle would go up. And with that and a 35 free cash flow multiple, that would give it an implied share price of $171 a share. So the stock still would look overvalued today. So maybe we up the exit multiple to 40, and now we're up to a $197 implied share price. But again, this is a very messy estimate that could go wrong in a lot of ways depending on the assumptions you make. So Oracle's kind of a stock that's difficult to value. But this is kind of the game with investing. You have to sharpen your own estimates and make sure you're making intelligent assumptions. But at the same time, you want to invest with a large margin of safety in case you're wrong. And the reality is you're going to be wrong a lot of the time. So when you buy, you want to make sure you buy at a price where you know you have that buffer to be wrong. So right now might not be the best time to buy Oracle stock after it just soared up a bunch, but there could be opportunities in the future. And sometimes you just want to be in one of these high growth businesses. So I saved this stock to my watch list just so I can keep an eye on it. And I'm not an expert on Oracle's business, so I might do a deep dive video in the future just to do some more research. And as I mentioned earlier, analysts have already started raising their price targets on Oracle stock. The current average price target is $206.55. with the highest price target on Wall Street at $246. The lowest is $150. And overall, analysts are definitely on the bullish side. But you should do your own research before making any investing decisions. I'm not an expert on Oracle's business, but I thought this was a really interesting story to cover with you today. If you enjoyed the content, please leave a like, comment, and subscribe to the channel. And if you want to use the tool I showed throughout, all of this is available at dividenddata.com. And right now is the best time to join because you can get 50% off for life. This is only going to be available for a limited time with our exclusive summer sale. It's the best price we ever offer. The link is in the description and pinned comment of the video. And if the tool helps you find just one better stock, then way more than pays for itself. You can try it out at no risk. There's a 30-day money-back guarantee. Use the link below, and I'll see you in the next video.